Is the Canadian multifamily real estate sector poised for a transformation with significant new investments? Well, it just might be, as Starlight Investments has announced the launch of a new $750 million fund aimed at acquiring purpose-built multifamily rental properties across Canada's largest urban markets. Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. According to CoStar News, Starlight Investments, a prominent player in the Canadian real estate market, is spearheading this ambitious initiative. The fund, known as the Starlight Canadian Core Multifamily Fund, aims to capitalize on the growing demand for rental housing in major urban centers across the country. This move underscores the increasing attractiveness of the multifamily sector, particularly in a time when housing affordability remains a critical issue for many Canadians. Partnering with CIBC Investment Management, which is contributing a substantial $415 million in equity to this venture, Starlight is well positioned to make a significant impact. The collaboration highlights the confidence institutional investors have in the stability and potential of the Canadian multifamily market. As urbanization trends continue, the demand for rental properties in cities like Toronto, Vancouver, and Montreal is expected to rise, making this fund a timely response to market needs. Starlight's head office in Toronto will oversee this fund, ensuring that investments are strategically targeted to maximize returns and meet the evolving needs of renters. With a focus on purpose-built multifamily rental properties, the fund is set to provide much-needed housing options in some of Canada's largest and most competitive markets. This initiative not only promises to boost the supply of rental housing, but also aligns with broader economic goals, such as supporting job creation through construction and management of these properties. As Starlight and CIBC move forward with this venture, the potential benefits for the Canadian real estate market are substantial, potentially setting a new standard for investment in the multifamily sector. The Canadian multifamily housing sector is ripe for growth, but it requires a broader investment perspective to truly thrive. According to a recent article from Biz Community, while impact investing has brought noticeable benefits to the multifamily housing sector, relying solely on this type of investment could hinder the sector's potential to scale. This is particularly crucial as housing demand and economic inclusion remain urgent priorities. Palisa McKay, CEO of the South African Multifamily Residential Rental Association, highlights that while the sector delivers essential social benefits, it should not be viewed purely as a social good. Instead, it needs to be recognized for its potential as a viable growth investment. Institutional multifamily assets, professionally managed with high occupancy rates and robust collection rates, demonstrate resilience and attractiveness as investment opportunities. The article notes that the South African multifamily housing sector, despite its strong performance, attracts low levels of institutional investment. To address this, efforts are underway to change perceptions through data-driven advocacy. The sector is not the 60% occupancy and 20% collection type of market some might imagine. In fact, the first quarter of 2025 saw occupancy rates of 95.8%. with bad tenant debts under 1%. This indicates a robust demand that far exceeds supply. The South African Multifamily Residential Rental Association, or SAMARA, plays a pivotal role in promoting transparency and credibility, focusing on rental housing rather than developments for sale. The organization holds an asset base of over 75,000 residential units, valued at more than 40 billion rand. Samara's advocacy aims to educate the market about the sector's investability, encouraging increased institutional investment. The multifamily rental sector continues to prove its resilience and remains an attractive investment asset. With significant potential for growth, increasing institutional investment is key to helping the sector scale. This will only be achieved if multifamily housing is viewed not solely as a social investment, but also through a broader lens that recognizes its growth potential and return on investment to attract new capital into the sector. In a remarkable transaction that underscores the vitality of the multifamily real estate market, Royal Crest Warwick, a 492-unit apartment building located at 42 Cedar Pond Drive in Warwick, has been sold for an impressive $132 million. This sale was facilitated by Walker and Dunlop Inc., who arranged the financing for the buyer as part of a larger real estate portfolio acquisition. The seller, Aimco Warwick LLC, a Denver-based limited liability company, has owned the property since 2002. The buyer, RC Warwick Gardens LLC, is a limited liability company based in Norfolk, Virginia. The acquisition was made by Harbor Group International, a global real estate investment and management firm with an impressive $20 billion in real estate investment properties under its belt. This transaction is part of a larger $356.4 million portfolio that includes several other properties in Massachusetts: Royal Crest Marlborough, a 473-unit apartment building in Marlborough; Wexford Village, a 264-unit apartment building in Worcester; and Waterford Village, a 588-unit apartment building in Bridgewater. According to Harbor Group International, the Boston area continues to showcase strong multifamily fundamentals, further solidifying the attractiveness of these investments. Yisroel Berg, Chief Investment Officer and Managing Director for the Multifamily Division at Harbor Group, emphasized the strong demand for multifamily housing in the Boston region. With limited new supply near each property, we are well positioned to leverage our local expertise to sustain strong occupancy and execute targeted renovations, Berg stated. Harbor Group's strategic partnership with Walker & Dunlop was instrumental in securing this successful acquisition financing. The portfolio consists of a total of 1,817 units and approximately 1.8 million square feet in rentable space. Craig West, Senior Managing Director for Capital Markets at Walker & Dunlop, highlighted the steady growth in demand for multifamily rentals in New England's suburban markets. This has been fueled by strong population trends, job growth, and a resilient local economy, making this acquisition a strategic opportunity for continued growth in the multifamily sector. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.